Everyone on the internet gives you the exact same advice. If you want to build wealth safely and smartly, put your money in an index fund and forget about it. It is the dominant financial rule of our time. But we need to look at why these funds were actually invented. Originally, mutual funds existed so you could hand off the difficult job of stock picking to an expert. The problem was, those experts charged massive fees. Index funds were created to cut those costs down to almost nothing. They absolutely succeeded in making investing cheaper, but in doing so, they completely abandoned the original goal of actually selecting the highest quality companies. Take the Nifty 50 in India. The assumption is that this basket holds the 50 top-performing businesses in the country. It does not. This setup creates a hidden contradiction. By following the herd into these 50 companies, you may find yourself participating in a mathematical structure that actually rewards high prices over high quality. The Nifty 50 index sorts companies using free float market capitalization. It only looks at how large and expensive a company is, ignoring underlying business quality. As a company's share price becomes more expensive, the algorithm automatically increases its weight in the index. Think about how you make decisions. You would never walk into a clothing store and demand to buy the most overpriced shirt on the rack simply because a crowd of people is staring at it. Because an index fund operates without human analysis, it forces your money to do exactly that, replacing financial logic with blind, forced momentum. Here's a factory earning 100 rupees. You buy a share for 500 rupees. The PE ratio is 5, a bargain. When it enters the Nifty 50, forced index buying pushes the price to 5,000 rupees. Output remains 100 rupees, but the PE rockets to 50, an expensive asset. It is exactly like standing in line for a samosa. The person in front of you pays 10 rupees. But because the line behind you is getting longer, you decide it is completely logical to hand over 100 rupees for that exact same samosa. This is the structural reality of index investing. It creates a self-fulfilling loop where collective, mindless buying artificially inflates stock prices, completely divorced from how the actual business is performing. There is an opposing framework to this momentum machine. It is called value investing. The entire premise is to figure out the true intrinsic value of an asset, buy it when it is cheap, and sell it when it becomes expensive. This is the exact philosophy that legendary investors like Warren Buffett used to build their careers. Partnering with Charlie Munger, their success was built entirely on independent, rational analysis, rather than following blind market momentum. Now, this does not mean index funds are entirely useless. If you are over 50 years old and your primary goal is absolute safety from the massive swings of mid and small cap stocks, a large cap index fund offers a stable basket of mature businesses. But if you are in your 20s, 30s, or early 40s, relying completely on an index fund sacrifices your ability to generate extra, market-beating returns, known as alpha. The index algorithm structurally ignores neglected, highly valuable stocks in the broader market. To build extraordinary wealth over decades, you have to actively seek out the value that the passive algorithm is explicitly programmed to miss. However, active investing comes with its own severe risk. Just because a stock looks cheap on paper doesn't mean it is a hidden gem. Often it is a value trap. The price is low because the underlying business is actively rotting from the inside. To stabilize your wealth during a market panic, you need a hedge that isn't tied to company earnings. This is why allocating a portion of your portfolio to precious metals is a common strategy. It protects you from equity volatility and country-specific risks that stocks alone can't escape. To succeed, you need an execution strategy that completely isolates your money from the herd mentality of mutual fund redemptions. And because you are buying businesses the market currently ignores, you must have the patience to hold them for 5 years or more while their true value is recognized. This is exactly why solutions like Phenology 30 or a highly ethical FlexiCap fund exist. They provide you with well-researched, value-focused recommendations, but you retain total control over your own execution. True long-term wealth creation requires independence. It means stepping away from the internet's blind indexed hype, doing the intellectual work, and approaching the market with patience and logic.